Well, good evening, everyone. Welcome back to the channel. We are back again with Jay Pestrichelli of Yieldmax. Welcome back, Jay. Glad to have you back.
Yeah, glad to be here. Thank you.
Yep. So we'll go ahead and get started right away. We had a great question come into the chat here. What are the chances of Yieldmax offering a weekly or even a daily ETF down the road?
Yeah, so well, we sell those options, weekly already. I kind of feel we're kind of doing that already.
Hmm.
If that means I'm not sure if you mean specifically like with weekly distributions. I think another shop did that. I think they're probably regretting that a little bit. I don't think it's all that additive to the offering, and then you get this inconsistency in the distributions, and it's things don't always end on an exact week if you roll early. So we've talked about it, but it's something that we think we're a little more effective on the weekly distribution while selling the options at whatever pace we think makes sense.
Right. Yeah, because Roundhill is doing it weekly now.
Yeah, I
They've
think,
got
yeah.
two of them. And the distributions have been pretty consistent. I mean, there's been a couple weeks they've been lower, but it's been impressive how consistent they've been.
That's good. Yeah,
Yeah.
I think, look, there's extra work and there's extra cost in it too. Like, call me
Yeah.
crazy, but we
True,
got
true.
30 of these things we're doing it for.
Exactly. And more in the works, right?
And more in the works.
Yep. Okay, so oh, and we had someone say don't do the weekly. Okay. So
Nice.
the big point of discussion, return of capital. What do you say to somebody that says return of capital is just taking the money I invest and giving it back to me?
That was the case for a lot of like traditional yielding products, right? Whether it's stock or, mutual funds in the past. For this, return of capital is simply it just in our scenarios, and by the way, this happens with every options based ETF, right? You could look at the QILDs of the world, the JEPIs of the world, right? It's very common because you have option positions that may lose money while the overall fund is still making money. Here's an example. For us, when a stock goes up and goes through our call, and we have to buy back that call for more than we sold it, we lost money on the call in and of itself, right? Meanwhile, we made money on the underlying moving up, right, through the strike. So what happens is we still want to distribute the time value that we earned in that short call because that's our promise. That's the idea of the fund. Yet the call lost money. So when I turn around and hand investors the time premium we made, but yet the call itself lost money, it's actually irrelevant, right? Because the underlying made the money on the offset. So that ends up being categorized as a return of capital because net we traded, lost money, but the fund still went up. So in those scenarios, that can happen when things actually go your way. Like technically, all of our covered call strategies are still bullish, right? We want the underlying stock to go up. So that's all that happens. Or it's a scenario where the stock drops a lot, and because of timing or whatever, we have to roll our synthetic. We made money on all the calls on the way down, and the synthetic might have lost money. It's okay. We're still going to distribute the income we made, right? So I don't think it's really a relative, it's not the concern that used to get in the past that, oh, you're returning my money to you. Actually, we're returning the time value we've made in the fund for that time period. It's just that the underlying might have caused other things to happen, right? That's really what is happening there. So it's not a big deal. And actually, I like return of capital because you pay less taxes on it. Like, I
Yeah,
don't know
there's a
why
big
people would be upset with it. You're getting the same yield you expected. Maybe you're paying less in taxes.
right. Yeah, there's definitely a
Yeah.
tax advantage to it. I just think there's a conception out there that I've heard all too commonly that, like with TESLY, with the NAV erosion of TESLY, and the return of capital, people seem to think that, oh, they're just giving me my money back to me and the NAV is dropping, even though there's really no correlation.
That's
As they
right.
say, yeah,
Yeah, no,
perception
that's
is
totally
reality.
true.
Yeah,
Look, the NAV erosion conversation, you know me, I won't call it that. Right? It's a
yeah,
symptom of the covered call strategy, right? We don't have contango, we don't have compounding problems, right? It's different, but I get it why everybody calls it that. But
hmm,
I'll always stick my foot in the ground on that one and be like, it's not NAV erosion.
yeah. Okay, we had another good one come in here. Ask about how Yieldmax holdings can be more advantageous than holding the underlying over time.
Yeah, so again, it's I would say, and I've said this before, for Yieldmax, it's about the yield. If you're looking for, it all depends what the underlying is going to do, right? You could take a look at what a high flyer does, like what MSTR does or CONY does, right? You look at those guys and you'd say, like, well, total return wise, wouldn't I be better off holding the stock? Yep, you would. Covered calls rarely outperform a dramatic up movement in a stock. However, in sideways or flat or down markets, the yield max positions will outperform. But again, I'd rather you not be in it while the stock is dropping, because ultimately it can end up having a loss. So what I would say is, like, again, it's Yieldmax is about generating that yield. I don't even compare the underlying performance of Yieldmax against the vehicle, because that just happens to be the vehicle for me to generate all this yield. Yes, I know it's always tempting to be like, look, I could have been in NVIDIA and I could have doubled or tripled my money, but I only made 150% in NVIDIA. But it's about the yield for NVIDIA, right? So if it's growth you want and you think you can pick a high flyer, then you will almost always be better owning just the stock, right?
Yeah.
On a high flying move. If it's the yield you're interested in, you're not sure what the stock's going to do, sideways movement, you're going to benefit from holding the Yieldmax portfolio. They're two different approaches. One's growth, one's alternative income.
And you've mentioned a suggestion before about like maybe holding like 50% of the underlying and then 50% in the Yieldmax
Yeah, there's
fund.
some folks that do that. Absolutely. Because look, if there's enough yield to go around in a lot of these, right? And I would say if you're looking for the yield, but you also want to have that growth, build the right mix of what you want that return to look like. Absolutely. Absolutely.
Great.
Again, I will mention both take long stock risk. You're always taking the risk of the underlying dropping. That's the same risk in both of those scenarios.
Yes, good point. Okay, let's see now. ULTI. Okay, do you consider ULTI a success, or are the kinks still being worked out?
So the general gist is, I wish we had higher appreciation of the underlying tickers, but where we've definitely seen success is in the distributions and the volatility we've been able to sell. So I think we've done a good job there with harvesting the volatility out of those volatile tickers, and even managing through some of the what I will say definitely the kinks in the portfolio requirements. So in the beginning, you saw a lot of synthetics. We went to stocks, had to go back to synthetics, and now we're back at stocks, and we think we've got that worked out. So there was a little bit of I'll say custodian challenges there. Strangely enough, maybe not strangely, but like 40 Act funds, like an ETF, are held to different levels of requirements than, say, what you would be held in your brokerage account. Even an IRA has looser rules than a 40 Act set of margin requirements. And so there was some back and forth on what was allowed and not allowed. It took us a little bit to work through that. I don't think that impacted the performance at all, because we were still selling the same calls we were always going to sell. I think, like I said, I wish, you'd like the underlyings to go up more often than going down. I think that's going okay for us, but we're really happy is the yield we're able to generate by selling those calls. The only other thing I would say is, now that the fund is over 100 million, which is great, by the way, quick growth to get there. We're going to end up having to either add more tickers or be more selective in the tickers we choose. You don't want to have too much of GameStop, for example, in your portfolio, right? So we're increasing either both the holdings and maybe even getting a little more, leaning towards a ticker that, while it might not have the highest volatility, it's going to have more stability when it comes time to roll those calls.
Mm-hmm. Speaking of GameStop, there's no GameStop fund in the works, I would think.
It's too small. Like, it couldn't support a Yieldmax full build. No.
Right.
Not to mention, again, you talk about requirements. So for those of you that saw the movie, right, Dumb Money, which was entertaining, I thought, as a market guy.
Yes.
There was a part in there where Robinhood had to shut down new positions being added. I remember living through that in 2021 for sure. It's not portrayed accurately in the movie, but the real thing is, there are higher requirements when stocks do that. And custodians are going to hold you at 100% of the assignment cost on that call. And so when you have a call, ULTI had GameStop in it. I think we bought it at like 14 and a half, and we had it called away at 15 or 16. Like, we made our money. That was fine. 2 days later, it was 75, right? It did a double to 30, another double to 75. The short calls in that portfolio get held at the assignment value of 75, right? It just makes it difficult to support a position like that. So again, it's a little bit of the nerdy part of the business, or the clearing part of the business. That's, not all that exciting, but it ends up causing challenges in a portfolio. So we have not filed for a GameStop Yieldmax. No. It's kind of what ULTI's there for, to pick up those ones we like that you can't do. For example, Reddit. We have Reddit in ULTI right now. You can't launch an ETF on Reddit right now, but you can put it in ULTI.
Interesting. And you're still rebalancing some of those stocks every so often?
Some weekly. Yeah. After today, you'll see, there's a decent rebalance that went on today after last week.
Yep. Okay. Would there be a benefit to holding TESLY and Crash at the same time?
Yeah, it's a good question, because you would think, one hedges and offsets the other. This is essentially, if you hold up both, but they both should have similar yields. I know we haven't had a yield on Crash yet, so I don't want to say what I'm not allowed to say yet, but we're selling volatility on the same underlying ticker, right? Well, the same rules are going to apply. There's a little bit of an advantage being short or being bearish versus long, but generally they should be similar yields. You've basically created a scenario that, if Tesla stays in a range of plus or minus, 7 or 8%, you should have a net gain, because you've got both of the premiums. And even though one side may lose and the other side should offset kind of between those strikes. Where it ends up being a problem is if you get the dramatic moves in either way, and then they'll stop helping you. So, for example, if Tesla was to drop 20%, Crash will only generate income for the first 5%, right? And after that, you got your 1% from the TESLY call, your 5% from the Crash put, and the downside participation. And then that's it. And then you have this other exposure, right? So on the larger moves, you're not hedged. You do have more of an offset holding both, but it's not like a neutral position. I don't want people to think it's like a neutral, but between the strikes of the short put and the short call of TESLY, the short put of Crash and the short call of TESLY, yeah, that's a nice place to be. You should be able to earn on both in that scenario.
So were you happy with the launch time of Crash? It launched kind of like right after Tesla earnings.
I wish we got it out earlier. I really did. But listen, I'm happy it's out there. It's going to take the universe a little time to figure this one out. When people hear a covered put, I think a lot of times they think married put, which are two different option strategies, right? Covered call, covered put, they're the same thing, just reverse. Whereas a married put is a hedged, protected position. So I'm hoping that once we get a dividend or two out there, we'll start to see a little uptake in the volume on Crash. But yes, I'm happy to get that unique kind of a ETF out there. There's nothing that exists like that. Single stock and inverse and high distribution rates. I think it's got its place.
Yep. Okay. Let's see. KJK Good says Palantir Fund.
Yeah, I think Palantir is in our latest filing, which we did on Thursday of last week. So Palantir is included in that filing.
Nice.
Other items in that are Alibaba, Carvana, DraftKings, Robinhood, JD, Mara, Palantir, Roblox, Shopify, I think, Shop, SMCI, and Taiwan Semiconductor. So a good group that were filed last week.
Wow. And so those are going to be going public within the next couple of weeks?
Well, no. So the process is you file, the SEC has 75 days to review, come back with questions. There's back and forth. So I wouldn't expect any of those for 3 months, but that is public information. I could share the link somehow with you if I can.
Okay.
Should I email it to you, or is there a place I could chat this to you?
Oh yeah, you can just put it in the there's a way to private chat, or you can even put it in the public chat if you want.
Oh yeah, okay. So
yeah.
Let's see if I can do that. I think I can.
Mm-hmm.
Sorry, I'm not used to using the.
We had a. You
That was
see.
a good one.
Yep.
Yeah,
It's all
sorry about that. I'm just trying to figure out how to get that in there. It's asked me to connect to YouTube, so I'm just going to email it to you.
That's fine. Yeah. Yeah, we had one hater comment there. TESLY.
Listen, I'm, you know, it's one of those. I will always address those things, right? And
Yeah.
my thought on this is, I would say it has not been a disaster, right? I mean, we've hit the yields that we've said we wanted. It's always been the risk of the underlying, and that is, you don't know. You don't know when a stock is going to be Coney or Nvidia, or it's going to be TESLY or ARK. The
Right.
unfortunate thing is it was like, that was one of the first ones, right? So there's, something to be said for learning so people can understand, what the dynamics are of these ETFs. And when you get something that whipsaws and then has volatility fall off, and, it's a little bit of a learning experience. It's just unfortunate it was the first one, but I think, people have figured it out. And of course, the brand has continued to gain momentum and, plenty of success stories along with the ones that haven't performed well.
Right. Right.
So
Okay, let's see. Yep. Okay, we have a detailed question here. For this month, most of your NVDY calls were in the money and at a loss. Are you going to use NAV reserve or rolling the synthetic to make distributions?
Yeah, I think we had to roll the synthetics once or twice. We may have to do it again after today. Today wasn't bad, right? Let's see, where do we go today? Yeah, another 7% up. So we'll probably end up rolling. So the good thing is, right, we always make our time decay up or down, right? Time decay goes to zero. Yes, it will cost us money to cover the calls. Got it. But in order to come up with that cash in scenarios where it's moving higher, kind of past where we entered in that call, yeah, we'll probably end up rolling the synthetics. And I think everybody has seen what has happened before when we've done that. We end up realizing a fairly large gain, and then that ends up having to find its way into the distribution. But we'll always start with making sure we distribute the time value of the calls we sold first.
Right. Okay, let's see. Wheel strategy for income. I know there's one fund that launched that's called Wheel that does the wheel strategy itself.
Yeah. So does everybody know what the wheel strategy is? You want me to do a 2-second overview of that?
Sure.
It's not something we're doing.
Right.
It's something that I'm familiar with, though. So wheel strategy is where you sell out of the money puts, basically like a limit order to buy when the market is lower, but you get paid while you wait, right? So stock's trading at 100, you sell the 90s, maybe you get $1 for that. And if the stock doesn't go down, great, you keep your dollar, and then you do it again. If the stock does go down, you end up buying at 90. Great, I bought at $10 cheaper than it was trading. Then you're long stock and you sell calls against that for income. And then if it bounces back up and goes through, you let it get assigned from the short call. So that's the wheel strategy. It's in a lot of ways, it's similar to at one point you have a covered call on like Yieldmax has, but you always still have all the downside risk of the stock, right? If that stock went from 100 to 50, in my example, you've got all that downside between 90 to 50. And then if you're selling, let's say 55 calls and it rebounds up, guess what? You just sold out. So you bought it at 90, sold it at 55, you had two $1 premiums. It still has the same kind of dynamic and risk of a Yieldmax, right? So you still take on that same similar whipsaw risk like a covered call or a Yieldmax will have in the wheel. So look, it's a popular strategy. I'm familiar with the fund. We're not trading or managing that, but it's an option strategy that exists, and so putting it into an ETF, I think, could be helpful for some people.
Mm-hmm. And then you'll like this one. Any other versions coming up that don't focus solely on income but NAV appreciation as well?
Yieldmax is all about the income.
Yeah.
Are there other funds that we manage that have more upside focus in addition to yield? Yes. We've talked about some of the defined funds in the past, like the SPYT, where we're using call spreads instead of just calls to generate the income and capture more of the upside. So that's, I would say that exists. There's been other ones filed there, QQQT, IWMT. So those are out there and effective. We just have to launch those. But for Yieldmax, I would say hold tight for now. You never know, but yield is always, the brand. However, we do know that there are some folks that have an interest in growth, and I think we, may or may not have something for them down the line. Nothing I could divulge. Nothing's been publicly filed.
Right. Okay. What percentage of the calls are being done at the money?
Should be very few, with the exception of times where we're rolling. So what does that mean? So let's say a stock goes up a little bit. Like this has happened a few times with Meta and Google, where the stock has gone a little bit up, and we can both raise our strike price and roll out of a call on a Friday and make our income target. In times like that, we may roll those right at the money, maybe even a little in the money, like a strike in the money. Generally, no. I think that's probably less than 10% of the time that we're doing that, but it can happen. Generally, we want to capture more of the upside. In that tactic I just mentioned, we would consider that as unlocking strikes, which means kind of unlocking more upside. So let's say you had 450s and you had to cover buy them for $5, and you could sell the at the money 470s for $12. That might be right at the money, but we just unlocked from 450 to 470 in upside appreciation on the synthetic, and we still got our income, yet that call might have been right at the money. That can happen sometimes, not all the time.
Okay. Let's see. KJ asks, how are they losing money on such solid intrinsic gains? Is he talking about
maybe the short call loses money at the intrinsic gain of the synthetic? I'm not sure.
I think someone said ULTI above here. I think that might be the context.
Oh, so someone asked I think he said, how are the NVIDIA calls losers? Just the short call might be the loser, right? In isolation, the short call might lose money. Yet the synthetic, probably just made $100 a share in the last week, right? So there's that. So they will offset, right? Because we still have to cover that short call that's deep in the money, but the long synthetic will offset that.
Yeah, he did ask up here, what proportion of monthly dividends are typically intrinsic? A little bit of a typo. And he's happy about
what proportion of monthly dividends are most of the time it's extrinsic, right? That is always kind of the core. If we have a large extrinsic, most of the time it's extrinsic. If we have a large intrinsic gain, because we'll just call that as the appreciation of the stock, we do have to distribute eventually a good chunk of that. And we've always defaulted to not queuing that up too much to the end. An ETF needs to distribute 90% of its profit from trading. Otherwise, it gets taxed, and nobody wants to do that. So we distribute that. In those scenarios, if it's large out of the gate or early on in a fund, we will definitely spread that out a little bit and distribute some of those. I think when you see, like, if NVIDIA, those months where it had 100% distribution, yet the implied volatility throughout the month was 50, you could do the math. Probably that was half and half of call extrinsic plus then intrinsic gains of the synthetic that rolled, right? So the upside capture. So I think that's probably the best way to have an idea of how that mix looks. We don't keep it a secret what our targets are. We tell you whatever the implied volatility on the underlying stock is, that's what we're shooting for when it comes to selling calls. We don't always get it, but that's what our target is. And so use that as your base, and then anything above and beyond that, you should assume it's the intrinsic gain from the synthetic.
Okay, let's see. Any future fund to funds in the pipeline, or a hint as to what may comprise them?
Yeah, I don't think we filed for anything else yet, but we are happy with the adoption of the YMAX and YMAG out of the gate. YMAX, actually, let me see if I have that number up in front of me. Today is somewhere in the 170 million. Like that's a pretty good jump for a fund-to-fund ETF. By the way, I like that fund for folks that aren't going to be too active, right? If you don't want to make your choices and where you want to jump around or be active in the funds, YMAX is a really good choice for folks that just like this idea. want a little less risk because it's diversified. So I would tell you that, we're happy with the success so far. Nothing specifically else to tell you, except when something works, we should do more of it.
Mm-hmm. And then let's see. How does Zega pick underlyings for new ETFs? Is there a system strategy, or is it just momentum driven?
No, I'm kidding. We look at things like what has volume in the market, right? What is popular? What's being traded? Obviously, that's important because we want to put out products that people want and that people will buy. So we'll look at that. We'll look at the implied volatility. Then there's constraints on the size. Like I mentioned before, GameStop just couldn't really handle it. Then there's costs. Lower priced underlyings mean more contracts, which means more commissions. So we'll put all of those, we'll wrap all of those up into the mix. We're always open to suggestions in case there's one we've missed, but we generally like to look at things that people are trading and want to give people an option to use the Yieldmax approach in case they're looking for distributions and income, but don't want to trade the options themselves. So popularity, volume, market cap, options volume, all of those things.
Okay. So a question from the Discord. Can you explain, like you're talking to a 5-year-old, maybe with examples or screenshots, how to hedge a Yieldmax fund to offset NAV dropping?
No. So I can't explain it. Maybe not. By the way, that reminds me of a line from a favorite movie of mine, Margin Call, where
Yes,
Jeremy
the
Irons
CEO.
says, explain it to me like I'm a 5-year-old or a golden
Yes.
retriever, right? He says something like
Yes.
that. So
Exactly.
great actor, great scene. So look, I would say it's difficult. First, it's actually not difficult to hedge, right? Buying a put is an easy thing to do, right? The one thing that you always want to remember is what are the distributions? You have to plan for that. And the market makers are going to also include that in the price of the puts. Puts, while they don't directly have the dividend included to them, they reflect a projected dividend, because what happens when we distribute a dividend? The stock drops. What happens to the put when the ETF drops? It goes up. So the market makers know this, and they will add in some extra costs. You could even see, if you go out a few months, what the market makers are projecting our distributions are going to be. By the way, they don't know because we don't communicate with them. We don't tell them ahead of time. Quite frankly, we know how we're doing, but I don't know what the distributions are going to look like in 3 months on NVIDIA. Just no idea, right?
There's other channels on here that do that too.
Yeah. Well, it's not easy to project what that's going to be. Mm-hmm. So buying a put, maybe a put spread is better to offset some of those costs. There are conversations where folks have sold in the money calls as well, right? Why would you do something like that? Well, selling it in the money call essentially is a hedge, is an offset. And you might be able to get better fills on those. I wish there was more volume on our options themselves to help create maybe tighter markets. When I look at some of the prices, they're really wide on those options. And I would finally tell you that this is something that advisors that work at Zega, that work for me, my advisor representatives, they get paid to do it. Right. So it's not the simplest strategy in the world and not the simplest thing to manage over time. Something you really want, it's something that, we do separately from managing the ETFs, where we manage portfolios like that. Mm-hmm. I'm not saying I won't answer because it's, you got to pay me to do it, but right. I'm saying there's quite a bit of research that you want to do on that. And you want to make sure that, you're just aware of the right tactics to deploy. To do that. Collars are a good way to do it, right? Buy the put, sell with the call. People do a synthetic sometimes, right? There's a lot of different ways to approach this. It's not a simple approach like just hedging Apple.
Mm-hmm. True. Okay. Next question. Has there been more inflows or outflows of the older Yieldmax products over the last 6 months?
I would say we continue to see inflows in, the bigger names like NVIDIA and Coinbase, right? Those continue to see inflows. I think we had money come into ARK today. That's nice to see that from time to time. Apple has definitely slowed down a bit. TESLY has slowed down a bit as well.
Mhm.
But you're right. There have been some newer ones. I'm just looking at my list here. Misty, of course, is doing well. ULTI is doing well. YBIT is doing well. I'd say it's a decent mix. I'm not sure if and when NVIDIA will overtake TESLY, but it looks likely at this point. Just it
Yeah.
has regular inflow. Same with Coney, right? They continue to have inflows where TESLY is flattened out a little bit, and I think that's probably expected considering the price action of Tesla over the last few months, right? I'm
Yeah.
not surprised by that. I would even say to you, remember, if you're bearish on Tesla, don't buy TESLY.
Mhm.
You can buy Crash now. So
Crash. Exactly.
buy
Yeah.
Crash.
Yep. Yep. And then we had a question about distribution for YBIT.
Yes. Have we had one of those yet? I don't think so, right? So forgive me, I don't
Probably.
remember.
Yeah, we
Did
probably missed the first month because of the timing of when it was
Yeah, so
released.
typically when we launch a fund, if it's halfway past, if it's halfway into the month, we'll wait till the next one.
Mhm.
So I'm sorry, I don't remember if we actually. Let me take a look at this. If we actually had a YBIT, I don't think we did. We'll be doing that math shortly, right? We're coming up at the end of the month here, so YBIT is a challenging one in the fact that BITO, the underlying, now has a fairly large distribution, right? When we filed for the distributions, when we filed for that one, I'm just looking. Nope, YBIT has not had one. When we filed for that one, BITO had very, very small distributions, and now it's larger. Now it's a bigger piece. And so if you're watching the portfolio on YBIT, you may notice that the synthetic is way far away from the price of the underlying, like 20%, 25% away, let's say 120% moneyness. So while YBIT's trading at 26, we have the 35 synthetic. And why do we do that? We do that because if there's an expected dividend in the call, it will drop by that amount, right? And so the synthetic would drop by the amount without getting the dividend. So guess where the dividend is reflected? I mentioned it earlier. It's in the put. So we'd rather sell the deep in the money put that is kind of embedding the theoretical dividend in it. And so if the stock drops, that's okay. I've already got paid for it in the put. And even if my long call drops, I think our long call is marking at a dime. I'm not going to get hurt much more than that. So there's a nuance with YBIT. So I'd say continue to watch how that gets managed. But BITO kind of changed along the way. It's one of those things that a student of the options market would might recognize that, and that was a unique approach. So, but I think like all things with Yieldmax, watch the implied volatility to get an idea of what the distribution will look like.
Mm-hmm. We've had this come up before, but another similar comment. They wish it was at 5 to 15% out of the money instead of where it is.
Yeah, so that's a great point, right there. By the way, sometimes we've captured that, right? We've captured the 10%, 11% move because it was built in. And we will watch for that even sometimes where we will go out 2 weeks because there's more juice in a 2-week option than a 1-week option because options are between the first and second week, or sorry, earnings are between the first and second week. So there are times where we will do that. A lot of times we do. This time that didn't happen. But if you watch what we've done with Netflix in the past and Tesla in the past, we will absolutely go farther out of the money when earnings are around. This time there was not as much juice into the options, and so the 1 weekers made more sense. Of course, in hindsight, stock rocketed and is still going. Would have been nicer to sell higher out of the money. But again, our priority is what? Yield, right? So we're going to capture that first. We want you to count on that first, and then we'll do as much as we can to capture the upside.
So building on that, someone asked, will they ever update the goal if the IV trend changes long term?
Probably not, right? I mean, let's say, Tesla's a really good example. Let me see where the IV was today. I mean, it wasn't the greatest day for it, but it's trading at a 45 IV. When we first filed for TESLY, the IV was 80%. right? It was much more attractive. So I don't think we would change much about, the goal of being yield first. It would require a prospectus change, and that's not undoable. You could do that, but it would kind of change the brand. Capturing more upside is something we're always working towards. I would leave it at that. It's not something that we are ironclad on. I think we are working to maintain the higher yield and looking at structures that get us higher upside capture. So I will leave it at that.
Okay. So I have to ask this one. What do you say to an investor that puts all their money in one Yieldmax fund like AMZY, takes a home equity line of credit, and calls it free money, the dividends?
Yeah, that's, as an advisor, that's not something I would advise, right?
Right.
So look, because like you're taking all this Amazon risk, right? Forget about the distributions, right? You're taking Amazon risk, right? You put all your money into Amazon, take a loan against your house for more Amazon risk. That's what you're doing. I mean, I guess there's some people that would do that, but I'd say it's a fairly aggressive strategy to follow. You have to be comfortable with that risk. I would never be comfortable with anybody taking that. I would never invest anybody that way. And I like Amazon, don't get me wrong. And I like the distribution. And if I trust Amazon will be around forever because we live in the Amazon world, I get all of that. It just seems way too concentrated. You never know what can happen at a company, right? I could rattle you off many companies that everybody thought were, the future of America that just didn't make it.
Oh, like Enron or one of those?
Sure. WorldCom was in there. I owned WorldCom back in the day.
Oh, yeah. So, yeah, covering Yieldmax, I think I've seen it all. Like there are investors out there that say that your dividends are better than owning real estate.
And look, I would say, look, and I'm still not recommending this, right? But YMAX is a better choice than Amazon, right? Alone. Only because, and I think they have similar distribution rates, right? Let me just take a look at the Amazon distribution rate, right? So, yeah, so maybe it's a little less, right? At 50, and YMAX is like 35, 40. So in those scenarios, I would say you'd rather take the safety of a diversified portfolio, kicking out still yields higher than owning real estate. I don't disagree with that, but at least take away the single stock risk, right? Mm-hmm. So you want to spread that out. I always talk about this being in what I would consider the alternative category as far as your investments go. So just realize that too. It's options based. If vol was to fall off, as somebody just asked a minute ago, but I don't think this is going to happen. But if volatility across the board dropped to the 20 range, then your distributions are going to go down too, right? That's also an unknown. So I always warn folks about this, and of course we love the support. Don't get me wrong. I'm not saying don't buy our stuff, but I'm just saying just know how to use it and pick the right vehicle for it.
Mm-hmm. Okay, another semi-hate comment. Not hate, but he says taking away from the NAV is not income.
Technically, that's correct. Income is, has a different. That's why I use the term distributions. Yeah. Right. Those are different things. Yield, distributions, and dividends and income are all, categorized a little differently from a technical perspective. That's okay, but yet we're still returning, the money that we're making from selling calls. I don't know if you probably are aware of this, right? This is kind of one of the success stories of the whole suite of products. It's probably projected by August, if things kind of go the way that they've been going, Coney will have returned more than the $20 that it launched with in last August. So as we get to the 1 year mark, there's the trajectory of the distributions of Coney are that you would have earned $20. And I'm not talking, reinvesting. I'm saying if you took every dividend and put it in your mattress within a year, there's a chance, all disclaimers apply here, that you would have got $20 back, right? You would have fully repaid back for your initial investment. I don't know a lot of things that'll do that. in the market, maybe like wildcatting oil wells, right? We'll kind of redistribute, their initial investment. So yeah, income is not necessarily the right term to use if you want to call the distributions, which I'm pretty deliberate about. But I think it makes sense to look at, you're actually generating this option premium through this process, and it's getting distributed back to you for sure.
And so after August, to be clear, so with Coney, everything from there on is the house's money, basically.
If you bought, the shares you bought when we launched in August of 23,
mm-hmm.
the way things are going, yes, and you still hold your shares. Yep.
In 1 year,
you didn't even reinvest.
Yeah.
Right. So not to mention the appreciation of the underlying, like what are we trading at today on Coinbase, right? Coney's trading at 24,
mm-hmm.
right? So you're even up on that. So like, look, the strategy, again, it depends on the underlying. The strategy can be something special like that, or it could be the total disaster of TESLY, as somebody said. And I wouldn't classify TESLY as a total disaster, by the way. I'm saying that jokingly, right?
I'm still holding the bag on it myself. Yep.
Well, if you're reinvesting, look, and you've got upside opportunity always on that one, right? But
yeah, I think one day Tesla will recover.
Yeah.
And you have said that. Yeah, to reiterate, you own all of these yourself.
I do own all of them.
Yep. Okay, let's see. We got a ton of questions. I'm not going to get to all of them, but let's see. Oh, here's one. As far as like a good dividend website. So some dividend websites, like Seeking Alpha, when they give you your total return, they're giving you just the dividends like being paid out, not reinvested. Any good recommended websites to calculate easier?
Yeah, the easiest way that I know to calculate kind of the total return is go to the historical pricing on Yahoo and pick your entry date. You put your dates in there and you use the adjusted price. That's going to be the best way if you don't want to pay for, Bloomberg terminals and stuff like that. Like that's free. Yeah. So just take a look at that adjusted date on when you got in. It'll adjust down the cost basis. And then you could use that to calculate the current value but just use the adjusted price.
Okay. Good to know. Let's see. Any plans for any international stocks?
Yeah, I think I rattled off a few earlier, right? Taiwan Semiconductor, Alibaba. So there's some that are making their way in.
What's your actual thoughts on the market at these all-time highs? Expectations from a master options trader?
Well, I won't call myself a master options trader, but I would say this. There's a lot of our general gist is markets go up over time, right? You want to be long the market. We're in an environment now where you have the two things that push equity values up are in your favor. You've got rates that are potentially going lower. Even just the idea of them going lower has pushed the market higher, right? And if they don't cut this year, they'll cut next year. All of that stuff looks like it'll persist. So you've got lower rates. The potential for lower rates is a good thing for equities. And then you've got corporate earnings expanded. Actually, the market is getting cheaper because earnings growth is outpacing the growth of the market right now. So corporate earnings going up. You've got interest rates going down. Those two factors alone make this a pretty bullish market. And when you look at kind of the signals, I'll give you an option signal we look at, right? We always watch, just looking at what the price is here. We watch the VIX and the VVIX, right? So the VIX with a 12 handle tells you there's not a lot of fear in the market. There's not a lot of speculation that the market's going to drop anytime soon. The other thing is when you look at the spreads between high yield and treasuries, which is also kind of a risk barometer, that is fairly low. So it doesn't look like a lot of risk there. And the last one is even the volatility of the options on the VIX itself is low. I mean, it's at 81 today, but it's been below 80. And that is generally a sign that there's not a lot of fear in the market and nobody's preparing for it. I know we had a day last week where I think the market dropped like 1.25%. We're above that already. Like we're getting past that. So, it's just one of those things that this is a scenario where, the upward bias of the market can last for a while. I know we've got an election coming. I absolutely expect volatility around the election. You can already see it in the options curve that October, November is more expensive to buy options than it is for September or even December. So, there's some, we're in that weird year, but generally this market has, the wind at its back.
Mm-hmm. Okay, let's see. Any thoughts on making a mid-level IV ULTI fund?
It wouldn't be ULTI, but yes, right?
Okay.
So maybe you don't have to go for the 100% yield, right? I think that's what the question is. Why not do, a little more stable build of stocks in like the 50% range? Sure, definitely something we've talked about.
Okay. If the underlying IV drops, is there ever a threshold upon which the fund will be closed because the IV is so low?
I don't want to say never, but that seems highly unlikely. It's the reason we didn't launch Berkshire Hathaway, right? Which was one of our original filings. It might be the last outstanding original not to be live because the IV is so low on it. We didn't think it made sense. I would think it'd be pretty hard for that kind of volatility to be in any of the names that we have, right? Even, look at Apple, right? Even Apple's still been worth doing while its volatility was lower than the S&P. So I would say, I don't want to say never, but it seems unlikely that would be the reason to close a fund.
Mm-hmm. Let's see. Target yield percentage, is there one for YMAX, YMAG, and ULTI each month?
No, there's not. Maybe ULTI has, a lean towards higher volatility in that, 100 range. But with YMAX and YMAG, it's going to be completely dependent on, the underlying components. And that is more of a what's going on with the volatility of the market than anything else.
Mm-hmm.
No target on those.
Okay. What would it take for ULTI to get back to $18, $19 range?
Yeah, it's the underlyings we'd need more appreciation in the underlying tickers that we select. It's absolutely doable with some of these. I think the other piece is, right, can we pick stocks where we can get, press that 15% out of the money range, right? Because they are a little more volatile, but it's really more of a factor of the performance of the underlying, like any covered call would have for that to happen. But it's absolutely possible for that to happen, especially in that fund, right? I mean, we're not capping it, 4 or 5% like some of the, even 2 or 3% like some of the other funds. This one, when you look at where we sell those calls, they are typically farther away than the other Yieldmax builds.
Mm-hmm. Let's see. Do you guys get audited or release financial reports on performance?
Yeah, that all comes from the custodian, which is U.S. Bank. All that information, we are absolutely audited. They run the accounting, the administration, third-party auditing, performance numbers. All of that comes out with things like quarterly reports and annual reports. That is all done by. That's what they get paid for. They take some of those basis points out of the management fee.
The management fee. Yep.
Yeah.
Okay. Any whales jumping into Yieldmax?
I don't know if that means big new tickers or big investors.
I
I'm
think
not
big.
sure.
Yeah, big institutions probably.
Yeah, we are
Yeah.
definitely seeing some pickup from the, I'd say, the advisor allocation world. None of the wirehouses yet because we're still too new.
Mm-hmm.
Typically, you need a 3-year track record, right? You have to have over 100 million in assets. Some of our funds have obviously met the asset size requirement, but time just takes a little time, right? So I get calls all the time from advisors at Wells Fargo, Morgan Stanley, Merrill, and they're looking, how can we add this to our portfolio? And I say, tell the gatekeeper to call me and we'll work through it. But we're happy to have you, add the fund to your platform. But a lot of those shops are restrictive on newer products like this.
Mm-hmm. Interesting. Okay, here's a good one. Like Mag 7, could you create a Yieldmax 7 or 5 or 6 using top performers from month to month?
We could.
Yeah.
Yeah. So when I said, there's things, when you asked, are there other fund-to-fund ideas out there? That's something we've talked about, that exact idea.
Yeah. And then we got to thank you for your answer.
You're welcome.
Let's see. This person thinks it'll come to a point where you can't manage so many funds. Less is better.
Yeah, I mean, we are continuing to add both. This is a question I get from the board all the time, right? The trust board, they say, can you handle all this volume that's coming? And so between people and technology, we do spend quite a bit of money to increase our capacity. Today we have multiple people whose 100% of their job is trading the ETFs. And meanwhile, we are using really our main trading partner and technology partner is Bloomberg. Doesn't get much bigger than that to kind of build out our capacity for things like reconciling our positions, making sure trades are going off at best execution, right? Making sure all the reporting is accurate. Believe it or not, there's more risk in the fund business and reporting than actually the trading.
Really?
Yeah. So strangely enough, we report our positions each night that the custodians don't see until trades get delivered to them. So you have to tell, and if you make a mistake in what you tell the custodian, like U.S. Bank, here's our positions, here's what we traded, you end up getting a bad NAV mark, right? So that the price can get skewed. So that is actually as big of a risk as opposed to us, fat figuring a trade or buying when we're supposed to sell. Knock on wood, those things don't happen with us, but it's more the reporting where there's more risk. And ETF companies have this problem all the time, right? Mm-hmm. So it's something that we're spending quite a bit of money on technology to make sure that we don't have those kinds of mistakes. But no, we get it. There's a lot of funds. I think today we manage, I'm looking at my list, 35 funds. It's probably going to be over 45 before the end of the year. So wow. You have to build the capacity to handle that kind of work.
Mm-hmm. I knew this would come up. You've addressed this before, but NVIDIA is going to split 10-for-1. When that happens, nothing really changes in the Yieldmax fund, right?
No, nothing will change, right? So our current options will all get the strikes and size will all get adjusted, right? Mm-hmm. Down, right? So obviously you won't have the 1085 strike when it's trading at 110, right? So it's all of those options will be adjusted. It won't change anything we're doing except just more volume, mm-hmm. right? So we'll just be doing 10 times the contracts.
This one's kind of funny. Why ULTI down all the time, even market up or down?
I wouldn't say it's down all the time, but yeah, look, it's a volatile portfolio, right? There's a lot of moving parts in that one. Like I said, when I wish we would have more success on the performance of the underlying tickers. I think we're doing a great job on the option portion. Making sure, like there's an argument to be made, and I'll be totally clear about this to anybody. The reason those stocks have volatility in them is because they have the propensity to move up and down dramatically, right? And so while we can have stocks that drop 10, 12% in a day, we can also have stocks that go up that much in a day. I mentioned GameStop earlier, right? Yep. That can happen. So, it's a function of the underlying tickers more than anything else.
Mm-hmm. Let's see. He means the VIX. With the VIX this low, doesn't the IV and thus the premium drop? Is this a challenging market for Yieldmax?
Sure, of course. And where it ends up being reflected is closer to the money options. Right, closer to the money calls get sold. So higher vol, we can hit our number, our bogey as far as our income level, but farther away. You look at the Apples of the world that have the lower implied volatility. Yeah, we're selling closer than we'd like to, but again, we should always be able to hit our target because the implied volatility is defined by the option prices, and we're selling those same options, right? So you may see IV drop, like I mentioned earlier. Tesla's got an IV of 45 right now. That's pretty low, right? So that will impact the yield on that fund, right? Mm-hmm. For sure. But we could still execute the strategy just a little closer to the money on those calls.
Mm-hmm. Let's see. Yes, we did go over return of capital already. Okay. I'm going to tie in two similar questions got asked. I'm going to ask this version of it, though. Typical day in the office on high volatility day. Do you do BTC calls proactively? Wait till expiration?
Typical day is actually starts the night before, right? Mm-hmm. Reconcile all your positions, make sure your funds are, everybody knows what they're supposed to know and everything gets marked properly. Those reports that get posted to the website that people look at, That's we want to make sure all of that is accurate. So really, our day starts, 8 o'clock at night. Next morning, confirming, the transactions with the custodians, and you start to look at the individual positions, what's going on each one of the stocks, anything we have to watch for. We have we use a lot of, real-time calculations to kind of tell us when calls are getting close to being rolled early. We'll look at things like concentration, right? So what'll happen is when a stock like NVIDIA goes through your strikes, the stock is growing faster than your fund because we're capped. So you have to look, hey, are we leveraged? Are we accidentally leveraged, right? Things like that. So you look at all the metrics in the fund to make sure you define your trading. You wait for the inflows and the outflows, which comes around 1 o'clock. You make your trading adjustments, add or remove or reduce positions based off that. Generally, we've been fortunate. There's inflows. Today, for example, is a good day in Coney, right? So if someone's watching the number of outstanding shares that we have, that helps you understand the growth within the funds. We have to add positions to offset those inflows. And then it's end of day trading and syncing it all out and building the end of day reports. And then you start that over again. But there's a lot of watching the market on the positions, not because we're timing when to get in and out. It's more of, hey, when do we need to take action on an early roll? Has a call made all of its money already? Time to move that up to what are we going to do with the synthetic in those scenarios? All of that. There's a question there about Bitcoin. Nope, we treat everything like the YBIT fund just like we do all the other ones.
Yep. And you've touched on this before, but yeah, how big is Yieldmax, assets under management, total employees? Are you expanding with all these new funds?
We are expanding. So Yieldmax has about $3 billion in assets in it. The employees at Zega, there's 15 here, not to mention the 60 plus a title, which is the kind of administrator and mothership for all of these funds. And both of us are adding. Both of us are growing.
So far, no one in the audience is asking for a job today. Let's see, indicators that your traders use.
We don't do a lot of market timing, right? Again, we let the options market, that's how it's easy to communicate to everybody what to expect, right, from the funds, right? We're not, do we nail this one? Do we trade it right at the exact right time? It's really hard to do, but because we have a process and a discipline there, it's very regular. While these are actively managed, we still do have rules that we follow. Like I mentioned earlier, things like closing calls that have made all their money and rolling them early. Don't just sit on them. Or, in a dropping market, cover those calls, sell another one. Sometimes half, sometimes all. There's a couple rules around that. But not a lot of, we're not doing a lot of market timing on any of these funds. They're all pretty well defined. Trend trading all of that doesn't really apply. But I will admit this: when right after MicroStrategy's launched, and it just happened to have that crazy run that it went through, we would say push those strikes higher, right? Like we'll push those as high as we can because this thing's on a run. But all within the prospectus. Don't get me wrong; we're not doing anything outside of that. But still, there's a little discretion in those strike selections.
Okay, well, that's going to wrap this one up. Thank everybody for tuning in. Couldn't get to all the questions, but we got as many as we could. Thanks, Jay, for coming back. For everyone watching, he's going to come over to the podcast, Brewing Great Returns, next. We'll be live on there within a few minutes. So thanks again, everyone. Thanks, Jay. Any last comments?
No, appreciate all the support. Glad to do these. I always see these as an educational opportunity. I always appreciate all the questions. Thanks so much for everybody's participation.
Yep, and thanks for coming back. We'll have you on again soon. All right, take care, everyone. Like, comment, and subscribe, and we will see you all in the next one. Take care. Bye. All right, I'm going to end it here.